So imagine you've just landed, like the absolute pinnacle of a job offer.
Oh, the dream job.
Right, the absolute dream. You are moving back to your home country to become the chief financial officer of a massive, highly prestigious investment corporation.
Okay, a huge deal.
Yeah. So you unpack your desk, you sit down, you start reviewing the financial statements on day one, and you spot a line item for something called deal fees.
Which always sounds a little suspicious.
Exactly. So you dig a little deeper, as a CFO should, and you realize these aren't banking fees. These are straight up bribes.
Wow.
Yeah, bribes being paid to local government officials to win investment contracts. And worse, they are being intentionally misclassified as legitimate operating expenses.
Which is just a terrifying moment for any professional. I mean, the blood just drains from your face.
Right, and you talk to your new colleagues about it, and they just, shrug. They tell you, look,
Yeah.
this is just how local business is done here. If we don't pay the deal fees, our competitors will, and we lose out.
It's the classic everyone is doing it excuse.
Exactly, it's a common practice. So what do you do? I mean, do you play along to protect your new company's market share? Do you just quietly look the other way?
It is the ultimate collision of personal ambition, local culture, and absolute rigid global standards.
Yeah.
And to answer your question, if you hold a globally recognized financial charter, you absolutely cannot look the other way.
Not even a little bit.
No, you cannot participate. In fact, you have to actively separate yourself from the entire situation, even if it means resigning on the spot.
Man. And that intense high-stakes collision is exactly what we are wading into today. We are unpacking the bedrock rules of the global finance industry.
The big playbook.
The ultimate playbook, yeah. We're specifically focusing on the overarching code of ethics and professional conduct that dictates how the world's top financial minds are supposed to behave.
Right.
We are going to explore those incredibly murky gray areas where money, loyalty, institutional pressure, and just basic human psychology all clash.
And it's vital to understand the sheer scale of what we're talking about here. We aren't discussing some theoretical list of polite suggestions that, just sit forgotten in a corporate HR binder.
Right. This isn't orientation day stuff.
Exactly. These principles dictate the management of trillions of dollars globally. Trillions.
That's a lot of zeros.
It really is. So whether you are an individual investor handing over your retirement savings or a professional walking the tightrope of modern finance, the entire system is built on a very fragile foundation of trust.
And if that trust evaporates,
The capital markets freeze completely.
which brings us right back to our CFO. This is a scenario based on a very famous industry precedent involving a professional named Victoria Adebayo.
Right, a classic case.
Yeah. She steps into this environment where bribery is essentially normalized, and the governing code for top financial professionals is incredibly explicit about this.
It states that you must understand and comply with all applicable laws of any government or regulatory body.
Right. But the kicker, the rule that causes so much friction, is what happens when laws conflict. When you operate across borders, you must always follow the strictest applicable law or regulation.
Yeah, and that's the mechanism that prevents a regulatory race to the bottom.
What do you mean by that?
Well, let's say you operate a trading desk. You can't just intentionally move your operations to a jurisdiction with incredibly lax financial laws or, no anti-bribery laws and claim, well, everything I'm doing is perfectly legal here in this specific country.
Oh, I see, like finding a loophole country.
Exactly. If your home country or the professional code of ethics you are bound by has a stricter rule against bribery, that stricter rule falls you like a shadow. You are bound by it globally.
Wow. And inaction isn't an option either, right? The standard is very clear that if you witness a violation like market manipulation or bribery, you can't just put your head down and do your own spreadsheet.
No, absolutely not. You must actively dissociate yourself.
That's associate. That's a strong word.
It's a powerful concept. It means physically and professionally removing yourself from the blast radius of the unethical behavior.
So what does that actually look like in practice?
That might mean reporting the activity up the chain to compliance. It might mean formally stripping your name off a research report that you know is misleading. And if the firm refuses to fix the systemic bribery, dissociation means packing your box and resigning.
Okay, I have to jump in and challenge this strictest law requirement for a second.
Go for it.
Especially when we talk about emerging markets or different business cultures. Let's use an analogy.
Okay.
If I'm driving on a highway in a foreign country and the local speed limit is 80 miles per hour, but I know my home country's speed limit is 50,
Right.
If I stubbornly, strictly adhere to my home country's 50-mile-per-hour limit, I am actually a massive hazard on that road. I am disrupting the flow of traffic, people are swerving around me, I could cause a wreck.
I see where you're going with this.
Right. So isn't strictly adhering to a foreign, stricter ethical standard
Hmm.
sometimes totally counterproductive to actually functioning in a local business environment? Like, if everyone in Victoria's market uses deal fees to keep the economy moving, isn't she just destroying her own company by playing by a different set of rules?
It is a very common rationalization, and the traffic analogy is exactly how people talk themselves into participating in corruption.
Oh, really?
Yeah. But the mechanics of the analogy fall apart when you apply them to systemic financial integrity.
How so?
Well, driving 50 in an 80 zone creates a physical hazard because of the speed differential, but refusing to pay a bribe doesn't create a hazard. It starves a corrupt system of capital.
Uh-huh.
The goal of a global code of ethics is not to blend in seamlessly with local customs. The goal is to establish an unshakable, globally recognized baseline of integrity.
So, to stretch the analogy, it's not about the flow of traffic.
Yeah.
It's about refusing to drive on a road that's built on a foundation of systemic extortion.
That is a much better way to frame it, yeah. Investors, whether they are sitting in London, New York, or Tokyo, need to know that when they hand their money to a chartered professional, that professional acts with the exact same baseline of integrity in an emerging market as they would on Wall Street.
Right, because otherwise the whole system means nothing.
Exactly. If you allow professionals to adapt to the lowest local ethical denominator, the entire concept of a globally trusted designation instantly falls apart.
So for Victoria, it does not matter if local competitors are winning bids through bribery.
Not one bit. By participating or even just by quietly doing the accounting math to hide the bribes as operating expenses, she is misrepresenting the firm's financials and participating in corruption.
That is a hard, bright line. It really underscores this idea of independence and objectivity. You cannot let your professional judgment be compromised by local pressures.
Never.
And speaking of compromised judgment, there's another fascinating area of professional independence that deals with how research gets funded.
Oh, yes. Issuer-paid research.
Right. There is a concept called issuer-paid research. And on the surface, this sounds completely scandalous.
It really does.
This is when the very company being analyzed actually pays the financial analysts to write the research report about them.
Oh.
How is that not a massive inherent conflict of interest? How can a company pay for its own report card?
I mean, on the surface, it sounds like a recipe for pure propaganda.
Yeah, exactly.
But to understand why it's permitted, you have to look at the structural mechanics of the financial markets.
Okay, break that down for us.
Massive companies, your Apples, your Microsofts, they have dozens of independent Wall Street analysts covering them because there's massive trading volume and institutional interest.
Right. Everyone wants to know what Apple is doing.
Right. But what about a brilliant small-cap biotech firm that just developed a new medical device? They might have zero analyst coverage.
Because they're too small for Wall Street to care.
Exactly. And without coverage, they can't attract investors. And without investors, they can't fund their research. So the market failure here is a lack of visibility for smaller companies.
So the small company effectively hires an analyst to shine a spotlight on them.
Yes, but with incredibly strict ironclad guardrails to protect objectivity.
What kind of guardrails?
Well, the analyst can accept the job, but the compensation must be a flat fee. It absolutely cannot be tied to the outcome of the report.
Oh, so they can't get a bonus for a good review?
Precisely. The company cannot say, we will pay you $50,000, but only if you issue a buy rating. That is strictly forbidden.
Makes sense.
The analyst must conduct the research completely independently, and most importantly, the compensation arrangement must be glaringly disclosed on the front page of the report.
It's essentially the financial equivalent of a sponsored video online. You know, you have to put ad right at the top, and you have to explicitly state, this company paid me to look at their books, but these opinions are entirely my own.
That's a perfect analogy.
That way, the investor reading it has the context to judge any potential bias for themselves.
Exactly. Transparency doesn't eliminate the conflict, but it gives the reader the power to evaluate it. And this all ties into the broader rules against misrepresentation and misconduct. You have to be honest about where your data comes from.
Plagiarism is a huge part of that, right? Taking another firm's proprietary valuation model and passing it off as your own genius is an obvious violation.
Oh, absolutely. A career ender.
But there is a really practical carve-out here for factual, recognized data.
Mm-hmm.
Like, if I'm writing a report, I don't need to cite the U.S. Treasury Department every time I mention that the current yield on a 10-year Treasury bond is 4.5%.
Right. Universally available macroeconomic statistics or historical stock prices are public facts.
You don't own the weather.
Exactly.
Yeah.
But the moment you take a competitor's interpretation of why that bond yield is going to rise next quarter and you paste it into your report without credit, you've crossed into plagiarism.
Okay, so it's the difference between stating a temperature and stealing someone else's weather forecast.
That is exactly the line.
And when we talk about misconduct, there's an interesting philosophical line drawn. The rules govern fraud, theft, and neglecting your due diligence. But minor civil offenses that don't reflect on your professional integrity aren't necessarily career-ending violations.
Right, they aren't looking for saints.
Like if a portfolio manager gets a parking ticket, or even gets arrested for civil disobedience at a peaceful environmental protest, the governing bodies aren't going to strip them of their credentials.
Because they are regulating professional trustworthiness, not acting as a morality police for every aspect of your personal life.
So what's the ultimate test?
The question is always, does this action show a lack of honesty, integrity, or competence that would endanger a client's money? Fraud does. A parking ticket does not.
Which perfectly sets the stage for the ultimate test of honesty in finance.
Oh, here we go.
The one thing every single person in the market desperately wants but isn't allowed to have. Secret information.
The forbidden fruit.
Let's talk about market integrity and the legendary mosaic theory.
This brings us right to the edge of insider trading, which is arguably the most aggressively policed area of modern finance.
The baseline rule is that you cannot act or cause others to act on material non-public information, often abbreviated as MNPI. Let's really drill down into the mechanics of those two words, material and non-public.
It's crucial to understand the distinction.
Information is defined as material if its disclosure would definitively affect the price of a security, or if a reasonable investor would significantly want to know it before deciding to buy or sell.
And non-public simply means it hasn't been disseminated to the broader marketplace.
Give me an example of the holy grail of MNPI.
Okay, if a pharmaceutical CEO pulls you aside at a charity gala and quietly tells you, our new Alzheimer's drug just failed its final clinical trial and we're announcing it on Tuesday, that is the holy grail.
Because it hits both criteria.
Exactly. It is highly material the stock is going to crash, and it is completely non-public.
Yeah.
If you short the stock on Monday morning, you are committing a severe crime. You will go to jail.
But the gray area is fascinating because ambiguous information doesn't count. If you are at that same charity gala, and that same pharmaceutical CEO just looks incredibly stressed, keeps taking angry phone calls, and leaves early, that's ambiguous.
Right.
You can't definitively link that sweating CEO to a specific price movement.
Which is where we introduce the mosaic theory. This is the intellectual heartbeat of high-level financial analysis.
The mosaic theory.
Yeah. The mosaic theory is the principle that it is perfectly legal and actually encouraged to act on a combination of public information and non-public information to piece together a highly valuable insight.
Okay, let's explore the mechanics of this because I want to make sure I understand the exact tipping point between brilliant research and illegal spying. Let's build an analogy.
I love a good analogy.
Say I want to predict the quarterly earnings of a massive retail chain. Let's call them Megamart.
Okay, Megamart.
If I sit in a lawn chair across the street and physically count the number of cars entering a Megamart parking lot every day for a month, that is clearly public information. Anyone with eyes can do it.
Correct. That's entirely public. In fact, modern hedge funds do this on a massive scale by purchasing anonymized public satellite imagery of parking lots to track retail foot traffic.
Right. So I'm sitting in my lawn chair. But what if I get thirsty? I go inside the Megamart, buy a soda, and I casually ask the mid-level floor manager, hey, seems busy. How many units of the new video game console did you sell yesterday?
Okay.
The manager says, oh, we sold out. We moved 50 units just at this store. Now, that manager's answer is non-public. It's not in a press release. But is it material? Where is the exact line where my detective work becomes insider trading?
This is the exact scenario analysts navigate daily. Let's break down the floor manager's comment. It is absolutely non-public information. You extracted it from a private conversation. However, is it material? Would the knowledge of 50 video game consoles selling at one specific store in Peoria, Illinois definitively move the global stock price of the entire Megamart multinational corporation?
No. It's a tiny drop in a massive bucket.
Exactly. It is non-public, but it is deeply non-material. So under the mosaic theory, you can ethically and legally use that conversation.
Oh, wow.
Yeah. You take that non-material, non-public data point. You combine it with public satellite data showing full parking lots nationwide. You combine it with public macroeconomic data showing a rise in consumer credit card spending. You combine it with a public reading of the company's past holiday earnings.
So you're putting it all together.
Exactly. You arrange all those tiny individual tiles, none of which are illegal to possess on their own, and suddenly you see a clear picture. You conclude Megamart is going to absolutely crush their quarterly earnings. You buy the stock, you make a fortune, and it is 100% legal. It is the reward for superior, painstaking research.
It really is like building a mosaic.
Yeah,
One blue tile tells you nothing. But arranged perfectly, you see the whole ocean.
that's beautifully put.
So the line is only crossed if a single piece of non-public information is so incredibly significant that it guarantees a price movement all by itself.
Oh.
Like if the CFO accidentally emails you the finalized unreleased quarterly earnings spreadsheet, that's the whole mosaic already pre-assembled.
Precisely. You didn't do the work to assemble the tiles. You were just handed the finished masterpiece before the public was allowed to see it. That is material, non-public, and highly illegal to trade on.
Got it.
The mosaic theory protects the grueling, deep dive work of analysts who scour the earth for non-material puzzle pieces that everyone else is too lazy to look for.
I love that framing. So let's assume you've done the work, you've assembled your mosaic, and you have these brilliant, perfectly legal insights into where the market is going. What do you do with them? How do you fairly distribute that incredibly valuable knowledge?
That brings us to what the industry considers a sacred duty, the duty owed to the client.
And sacred duty is the correct terminology, isn't it? Under the standard of loyalty, prudence, and care, the client's interests absolutely, unequivocally supersede the firm's interests, and they certainly supersede the professional's personal interests.
Yes. But the very first hurdle here is defining who the client actually is, because it's not always the person writing your paycheck.
This is where it gets tricky.
It trips up a lot of professionals, especially in institutional finance. Let's say you are hired by the executive board of a massive manufacturing corporation to manage their workers' pension fund.
Okay.
The executives hired you, they negotiate your fee, and you report to them. But they are not your client.
Wait, they pay you, but they aren't the client.
Nope. The client is the ultimate beneficiary. Your duty of loyalty is owed entirely to the thousands of factory workers who are relying on that pension for their retirement.
Oh.
This is a classic principal-agent dynamic. If the corporate management team comes to you and subtly suggests that you should invest a large portion of the pension fund into the company's own stock to artificially boost the share price, you have to refuse.
Because that would be incredibly risky for the worker's retirement.
Exactly. It might benefit the executives who hired you, but it wildly dangerously concentrates risk for the workers. Your loyalty bypasses the boardroom and goes straight to the factory floor.
And once you know who your clients are, you have to treat them all fairly.
Uh-huh.
This is the standard of fair dealing.
A huge standard.
When you make an investment recommendation or you take an investment action, you cannot play favorites. A great mechanical example of this is how firms handle block trades.
Block trades are fascinating mechanically. Let's say a portfolio manager decides that Apple is a great buy, and they want to buy 500,000 shares for their various client accounts.
Right.
You don't just log into an app and hit buy for 500,000 shares all at once. If you did, the sheer size of your order would instantly drive the price of the stock through the roof.
Right, supply and demand. You'd be bidding against yourself.
Exactly. So the trading desk will slowly buy those 500,000 shares over the course of the entire trading day. They might buy 1,000 shares at $150 at 9 a.m., and by 3 p.m., the price might have drifted up to $152.
Okay.
So you have a whole basket of shares bought at different prices. Fair dealing means you cannot take all the cheap $150 shares and put them into the account of your wealthiest, most lucrative client, and then dump all the expensive $152 shares into the accounts of your smaller retail investors.
You have to average it out.
Yes, the firm will calculate the volume-weighted average price, the VWAP of the entire block trade, and every single client gets the exact same average execution price allocated on a pro rata basis based on their order size.
So it's completely mathematically fair.
Exactly. It ensures a small investor gets the exact same fair shake as the billionaire.
But let's look at a scenario where fair dealing creates an outcome that actually feels incredibly wrong on the surface. There is an industry precedent we can call the brothers IPO.
Oh, this one always causes arguments.
I can see why. Let's explain an IPO. An initial public offering is when a private company first lists its shares on the stock market. Now, highly anticipated IPOs are famous for popping.
Right.
The investment banks intentionally underprice the shares slightly to create hype, so on the very first day of public trading, the stock price rockets up 20% or 30%.
Mm.
Everyone wants in on a hot IPO
Right.
because it is practically free money.
It is arguably the most coveted allocation in retail finance.
So imagine a portfolio manager gets an allocation of these golden ticket shares in a massively oversubscribed hot tech IPO. The rules state that the manager can allocate some of those highly desirable shares to their own brother's account.
Yep.
Like, mechanics and rules aside, how is that not the absolute definition of nepotism? Why is a strict ethical code allowing a manager to hand free money to their family member?
It absolutely looks like nepotism until you look closely at the conditions. The manager can only do this if the brother's account is a standard fee-paying client account, structured exactly like any other client's account.
Oh, I see.
The brother pays the same management fees, signs the same paperwork, and has the same documented investment objectives. Under the rule of fair dealing, you cannot discriminate against a client simply because they share your last name.
Oh, wow. So if the brother is a paying client and the IPO matches his risk profile, excluding him would actually be the ethical violation.
Precisely. If you exclude him, you are actively harming a fee-paying client to avoid the appearance of a conflict. That said, the manager cannot favor the brother.
Meaning he can't give him all the shares.
Right. If the IPO allocation is tiny and every client is only getting 2% of what they asked for, the brother only gets 2%. He gets his pro rata share treated with absolute cold mathematical equality alongside total strangers.
That is a brilliant nuance. But you mentioned risk profiles, and that is a massive cornerstone of client duty suitability.
A very, very big deal.
You cannot put a client into an investment that doesn't match their risk tolerance, their time horizon, and their financial goals. And to illustrate what a catastrophic failure of suitability looks like, we have to talk about Madame Tan Sweeney and the oil futures disaster.
This is one of the most painful, illustrative examples of how complex financial mechanics can be used to exploit retail investors.
Let's set the stage. Madame Tan is a 70-year-old woman. She accumulated a modest nest egg through real estate, but as she got older, she did the responsible thing. She moved her life savings into very safe, highly liquid fixed bank deposits and low-risk utility stocks.
Very normal, very responsible for her age.
Right. She just wants a little bit of steady income to help pay for her grandchildren's education. She sits down with an advisor named Sim. Now, Madame Tan tells Sim she has heard friends talking about these new structured notes linked to oil futures.
Uh-oh.
But she explicitly admits she has absolutely no idea how oil futures work.
And this is the moment where an ethical advisor hits the brakes, but Sim hits the gas.
Sim hands Madame Tan a glossy brochure about these complex, high-risk, oil-linked notes. But there's a massive problem. The brochure is entirely in English, and Madame Tan only reads Chinese.
A huge red flag.
So Sim just verbally summarizes the brochure for her in Chinese. He focuses on the flashy headline, a potential 10% coupon payment. He casually mentions that the coupon isn't guaranteed and that there's a penalty if she takes her money out early.
He's downplaying the risks entirely.
Totally. And based on this verbal pitch, Madame Tan invests half of her entire life savings, $50,000, into these notes.
Mechanically, let's look at what Sim just did. A structured note linked to oil futures is not a stock. It is a highly complex derivative product.
Right.
It usually combines a standard bond with a derivative contract that bets on the volatility of global oil prices. If oil prices stay within a certain narrow band, you get a great payout. But if oil prices crash or spike violently, the derivative blows up and your principal and your actual initial investment is wiped out.
Which is wildly inappropriate for a 70-year-old whose primary goal is preserving capital for her grandchildren.
It is the definition of unsuitability. Just because a client asks about a product they heard about at a dinner party does not mean you are absolved of your duty to evaluate if it's right for them. Sim completely failed his duty of prudence.
And the language barrier just makes it worse.
Oh, absolutely. Reading an English brochure about derivatives in Chinese, summarizing it on the fly, and skipping over the complex mathematical risks of early redemption penalties, that is a catastrophic failure of care.
And the inevitable happens. Oil prices drop globally. The derivative structure of the note collapses. Madame Tan sees her statements, panics, and tries to pull her money out early to save what's left.
Which triggers the penalty.
Exactly. She gets hit with devastating early redemption penalties, loses a massive chunk of her life savings, and files a massive regulatory complaint against Sim. It is a textbook example of why suitability requires deep, mechanical understanding of both the product and the human being buying it.
And this duty of honesty extends to how you present your past successes to those clients. This is the standard of performance presentation.
Right. If you are an advisor trying to win Madame Pan's business, you're going to show her a chart of how great your previous investments have done. But there are strict rules against manipulating that data. One of the most common tricks the rules prohibit is cherry picking.
Cherry picking is incredibly deceptive. Mechanically, it usually takes a form of survivorship bias.
Let me build an analogy for this. Imagine I'm trying to convince you that I am the greatest baseball coach in the world.
Okay, coach?
I hand you a spreadsheet of my players, and their batting averages are all incredible. They're all hitting home runs. What I don't tell you is that I purposefully deleted all the players who struck out and quit the team mid-season. I'm only showing you the survivors.
Ah, I see.
If you calculate the average, including the players who failed under my coaching, my stats are terrible.
That is exactly how survivorship bias works in finance. A portfolio manager might launch 10 different mutual funds. 5 of them do terribly, lose money, and are quietly shut down and terminated after 2 years.
Just disappear.
Right. The other 5 happen to get lucky and perform beautifully. When the manager creates their marketing brochure, they only show the 5 successful funds. They pretend the failures never existed.
That's so misleading.
It is. The ethical standard mandates that performance presentations must include the data of terminated accounts. You have to show the whole baseball team, including the ones who struck out.
You have to show the ugly truth alongside the wins. Now, there is one more vulnerability for clients that we need to cover, and it's uniquely modern. It involves the preservation of confidentiality in the age of technology. Let's look at the scenario of Marcia Lopez.
Marcia's case is a brilliant example of how traditional ethical frameworks are struggling to adapt to the velocity of the internet.
Marcia is a highly successful private wealth manager. She manages money for very wealthy, high-net-worth clients. She wants to be innovative and build a sense of community, so she decides to create a private social media group, like a gated Facebook group or a Discord server exclusively for her clients.
Seems like a good idea for engagement.
Right. The idea is that she will post her weekly economic outlooks, and clients can chat about macroeconomic trends. Now, she does everything right on paper. She gets approval from her firm's compliance department. She explicitly warns every client who joins. This is a public platform. Do not, under any circumstances, post your personal financial information or account balances here.
She built a walled garden and put up warning signs.
But human nature is undefeated. A few weeks in, the market takes a dive. One of her clients gets emotional, logs into the group, and posts a long rant detailing exactly how much money they lost, giving away highly confidential, exact details about their personal portfolio.
Oh, no.
Marcia is in a meeting, so she doesn't see it immediately. 2 hours later, she logs on, sees the post, panics, and deletes it immediately. But for 2 hours, every other millionaire in that group could see this person's private financial devastation. So the question is, did Marcia violate the code of confidentiality? She didn't post it, she warned them, and she deleted it.
It is a phenomenal gray area. The violation isn't necessarily that she set up the group because she cleared it with compliance.
Right, so where's the foul?
The ethical failure is a lack of foresight regarding the inherent structural risk of the technology she chose to use. By creating a semi-public digital environment where a client could easily, impulsively broadcast their own confidential information to other clients with the click of a button, she essentially built a hazard.
So even if the client shoots themselves in the foot, you are liable for handing them the loaded gun.
Exactly. When you communicate via a secure one-on-one encrypted portal, the client can't accidentally reply all to your entire client roster. Social media platforms are designed for frictionless broadcasting.
Yeah, that makes sense.
Using a broadcasting tool for a relationship that requires absolute confidentiality is a structural mismatch. It requires a completely new level of ethical vigilance.
That is a terrifying thought for any advisor trying to be tech-savvy. So, we've established that you owe your clients your loyalty, your prudence, and your absolute secrecy. But what about the people who actually pay your salary? What do you owe the firm?
That brings us to the complexities of employers, independence, and the rules around recreation.
Right. The overarching principle here is the duty to employers. You must act for the benefit of your employer, and you cannot deprive them of the skills and abilities they hired you for.
And the application of this can seem incredibly strict, even bordering on petty.
Let's look at a hypothetical. You are a senior portfolio manager. You make a great salary. In your free time, on the weekends, you want to volunteer to manage the small endowment fund of a local charity. It is completely unpaid. You are just doing a good deed.
Okay, very noble.
However, the charity says, hey, as a tiny thank you, we're going to give you a dedicated premium parking space in our downtown garage so you don't have to pay for parking when you visit. According to the professional standards, you absolutely must disclose this entire arrangement to your employer and get their written permission before you accept the parking spot.
To a layman, requiring written corporate consent for a charity parking spot sounds like bureaucratic insanity. But mathematically and ethically, it makes perfect sense.
Walk me through the mechanics of why. It sounds crazy.
Well, you are an investment professional. Analyzing markets and managing money is your core professional competency. It is the specific asset your employer is purchasing with your salary.
Right?
By taking on an outside role, managing money, even for a charity, you are theoretically draining your mental energy, your time, and your focus away from your employer's clients. You are competing with your employer for your own capacity.
But it's unpaid.
Is it? That premium downtown parking space has a definable market value. It might be worth $300 a month. That constitutes compensation.
Oh, wow. I didn't think of it like that.
The moment you are receiving any form of outside compensation, cash, stock, or parking for utilizing your core professional skills, the risk of divided loyalty emerges. Your employer has the right to evaluate if managing the charity's money will distract you from managing their money.
It's about protecting the exclusivity of your professional brainpower. Now, what about the people at the top of the firm? The managers. The rules are ruthless when it comes to the responsibilities of supervisors.
The core tenet is that supervisors cannot play dumb. You cannot purposefully ignore red flags to protect your team's revenue.
Let's look at the classic precedent of Jane Balmer and her subordinate Graham. Graham is a young, aggressive portfolio manager. Jane is his boss. Graham is managing an account for the Delaney family. Much like Madame Tan, the Delaneys are conservative investors with a low-risk tolerance.
Okay.
But Graham has gone rogue. He's actively churning their account.
Let's pause and explain the mechanics of churning because it is one of the most insidious ways to destroy a client's wealth.
Please do.
Churning is when an advisor buys and sells securities in a client's account at a massive, rapid pace, not to make the client money, but simply to generate trading commissions for the advisor.
It's death by 1,000 cuts.
Exactly. Even if the stocks Graham is buying aren't losing value, the sheer velocity of the trading destroys the portfolio. Every time he buys, he pays a spread. Every time he sells, he generates a taxable capital gains event for the Delaneys. He is effectively bleeding their account dry to pad his own commission sheet.
So Jane Balmer, the supervisor, sits down to review Graham's accounts at the end of the year. She sees the insane trading volume in the Delaney account. She knows their conservative risk profile. She instantly recognizes the smoke.
Right. She sees the red flags.
She calls Graham into her office, has a stern conversation, and says, "This looks bad." She then formally refers the account to the firm's central compliance department and asks them to look into it. Following the meeting, Graham gets spooked. He realizes he's being watched, so he voluntarily stops churning the account. The trading volume drops back to normal.
Oh.
So from Jane's perspective, problem solved, right? She spotted it, warned him, flagged compliance, and the behavior stopped. Did she fulfill her duty as a supervisor?
Not even close. Jane is equally on the hook for a massive ethical violation. She failed her duty of supervision.
Wait, why? She told to compliance.
Passing the buck to compliance is not supervision. As his direct manager, the moment she saw evidence of churning, she had an affirmative duty to immediately open a full investigation to determine the exact severity of the damage.
Oh, she can't just pass it off.
Right. And more importantly, she needed to place strict, immediate limits on Graham's trading authority until the investigation was complete. Having a quick chat and sending an email to compliance does nothing to protect the client in the interim.
Because he could still be trading.
Exactly. Furthermore, the fact that Graham stopped churning after the meeting is irrelevant. He didn't stop because he was rehabilitated. He stopped because he got caught. The Delaney's account was already bled dry. Jane saw the smoke, casually pointed at it, but refused to grab a fire extinguisher.
That is a brutal standard for middle management. You are essentially a financial first responder. Now, let's pivot slightly to the actual process of doing the work, the standard of diligence. This requires that every investment recommendation you make has a reasonable and adequate basis. And this applies even if you are just passing along someone else's work.
This is a massive trap for analysts. You cannot blindly rely on third-party research.
Right. If a massive, reputable Wall Street bank publishes a 100-page report saying a new tech stock is going to double in price, you can't just take their report, slap your phone's logo on it, and send it to your clients as your own recommendation.
Absolutely not.
You have to independently verify the objectivity and the rigor of that third-party research. You have to understand their methodology. If their model is flawed and you recommend it, it's your reputation on the line, not theirs.
And you have to prove that you did that diligence. Which brings us to record retention. The rule is simple. When in doubt, keep everything for a minimum of 7 years. Your spreadsheets, your meeting notes, your emails.
Even if the client begs you to delete them, the records are your armor against future lawsuits. But this requirement to prove your work leads us to what I think is the most mind-bending, contentious rule in the entire financial curriculum. The changing firms rule, also known as the recreation rule.
Oh, man. Analysts hate this rule with a burning passion, but it is structurally necessary.
Okay, let's unpack the mechanics of this. Imagine you are a brilliant, once-in-a-generation analyst. You work for Firm A. Over 5 years, you build a massive, incredibly complex, proprietary algorithmic spreadsheet that perfectly predicts the valuation of semiconductor stocks. It is your masterpiece.
Okay, I'm with you.
Because of your success, a rival firm, Firm B, offers you a massive bonus to go work for them, so you resign. Now, under the rules, you cannot take a USB drive with your spreadsheet on it. You can't take your code. You can't take your physical models.
Correct. That spreadsheet is the intellectual property of Firm A. They paid you to build it on their time. Taking it is theft.
I understand that. That's basic corporate law. But here's where the ethical standard goes to an extreme. The rule states that you also cannot rely purely on your memory to immediately issue the exact same research report the moment you sit down at your new desk at Firm B.
That's true.
Even if you have a photographic memory, you must actively recreate the entire supporting analysis from scratch using public data before you can issue a recommendation. I have to push back on this. This feels like the rules are forcing humans to act like broken computers. Let's use an analogy.
Go for it.
If a master chef leaves a 3-star Michelin restaurant to open their own bistro across town, the old restaurant can absolutely keep the physical recipe book. That's their property. But they cannot wipe the chef's brain.
Right, the chef still knows how to cook.
Exactly. The chef remembers exactly how much salt goes into the bouillabaisse. They remember the exact temperature for the sear. If I am an analyst and I remember exactly how I calculated the discount rate for a stock valuation, why on earth do I have to pretend I got amnesia, forget everything I know, and start over from scratch?
It's a great analogy, but it's the perfect analogy to highlight the difference between culinary arts and heavily regulated financial markets.
How so?
A chef never has to legally prove to a government regulator why their soup tastes good. A financial analyst must be able to prove, with a documented paper trail, exactly why they are telling a client to risk their life savings on a stock.
Oh, the burden of proof.
Exactly. Standard VA requires a reasonable and adequate basis, supported by appropriate research and investigation. A memory in your head is not a basis.
You can't audit a memory.
You cannot show an SEC auditor your memory. You cannot hand your memory to a judge during a lawsuit. If you sit down at Firm B on Monday morning and immediately hit publish on a buy rating for a semiconductor stock based solely on what you remember doing at Firm A, Firm B has zero supporting documentation.
Yeah, that makes sense.
If the stock crashes on Tuesday and the client sues Firm B for negligence, Firm B opens its filing cabinets and finds nothing. No spreadsheets, no models, no proof of diligence.
Oh, wow. So the firm is totally exposed.
The recreation rule exists so that your new firm has a physically documented, auditable, independent basis for the advice being given under its name. You have to rebuild the recipe book from scratch, using publicly available ingredients so that Firm B owns the proof of your diligence. It is entirely about institutional liability and the audit trail.
That makes profound sense. It is agonizing for the analyst, but it protects the firm from inheriting naked risk. Your brain is yours, but the firm needs the paper. This blurring of lines between what you know, who you work for, and who owns the output leads us perfectly into our final arena. The unavoidable reality of the financial industry, conflicts of interest.
Conflicts of interest are like gravity in finance.
Yeah.
You can't turn them off. They're always pulling at you. Standard 6 dictates that since you can't eliminate them, you must neutralize them through full and fair disclosure.
Bring it into the light. And a major everyday area for this involves referral fees. Let's look at the arrangement between Hearn Investments and Baker Brokerage. Hearn Investments is a small firm that writes really good niche research reports on emerging market equities. Baker Brokerage is a massive trading firm.
Okay.
They strike a deal. Hearn agrees to give Baker all of its emerging market research for free. In exchange, Baker agrees to refer some of its wealthy clients over to Hearn, and Baker also gives Hearn access to its massive library of European equity research.
Mechanically, this is a classic soft dollar or back-scratching arrangement.
Right.
No actual cash is changing hands, but immense value is being traded.
Right. And here's the thing. Hearn's clients are absolutely thrilled. Thanks to the free European research Hearn is getting from Baker, Hearn is making fantastic investment decisions, and the clients are making great returns. Everyone is getting rich.
Sounds great so far.
But Hearn never explicitly told its clients about the backroom deal with Baker. So, no one lost money, no one was given bad advice. Did Hearn violate the code?
Absolutely, because the code doesn't just protect against actual harm, it protects the client's right to evaluate partiality. Clients must be told about referral fees and soft dollar arrangements so they can accurately judge the true hidden costs of the service.
How does it change the client's perspective? I mean, they're making money.
Imagine you are a client of Hearn. If you know Hearn is essentially getting paid in referrals to use Baker's research, you might look at Hearn's sudden enthusiasm for European stocks with a slightly more skeptical eye.
Oh, I see.
You might ask, are you putting my money into these European stocks because they are truly the best investment, or are you just heavily relying on Baker's research because you have a cozy, lucrative referral deal with them?
It's about knowing the motivations.
Disclosure is the sunlight that disinfects potential bias. If you hide the deal, you steal the client's right to ask that question.
That is incredibly clear. Now, before we look at our final mind-bending case study regarding conflicts of interest, I want to briefly touch on the meta-ethics of the industry itself. Standard of responsibilities as a candidate. This governs the integrity of the grueling exams people take to earn these financial charters.
The exams are notoriously brutal, and the security around them is absolute.
There's an industry precedent involving an exam prep instructor named Marotra. He teaches a class to help candidates pass the test. A few days after the massive global exam date, he emails his students. He doesn't ask for the exact questions, but he asks them, hey, broadly speaking, what were the most difficult topics? What formulas were heavily tested? And what parts of the syllabus didn't show up at all?
And that seemingly innocent question is a massive violation of exam integrity.
Why? He's not cheating on the test himself? He just wants to tweak his curriculum to be a better teacher next year.
Because he is crowdsourcing the anatomy of the exam. The governing bodies recycle questions and test themes across different geographic zones and timeframes.
So giving hints ruins it for others.
Exactly. If you publicly reveal the weighting of the topics, if you tell the internet, hey, don't bother studying fixed income derivatives, it wasn't on the test, you have fundamentally compromised the fairness of the testing process for the next wave of candidates.
That makes sense.
You are allowed to publicly disagree with the CFA Institute. You can write a blog post complaining that the exam is too hard or the grading is unfair, but you can never, ever pierce the veil of silence regarding the specific contents of the exam.
It's the Fight Club rule of finance exams.
Yes.
You do not talk about the exam. Okay, let's dive into our final case study. I call this the Ants Trust. This scenario tests the absolute limits of what constitutes a conflict of interest, diving deep into human psychology.
This is one of my favorite precedents because it forces you to look decades into the future.
We have a financial analyst named Daniel Lyons. Daniel's specific job is to write public research reports covering a corporation called Horizon Company. He tells the world if Horizon is a buy, sell, or hold. Now, Daniel has a wealthy aunt. She owns 30,000 shares of Horizon Company.
Which is a very sizable, concentrated position.
Very. The aunt decides she wants to leave Daniel an inheritance. So she legally creates a trust in Daniel's name, and she transfers 2,000 shares of Horizon into this trust. But here is the massive catch: the trust is structured with an ironclad legal lock.
Okay, a lock.
Daniel absolutely cannot sell the shares, he cannot touch the dividends, he cannot access a single penny of value from that trust until his aunt passes away. However, the trust does grant him the immediate power to vote those 2,000 shares in Horizon's corporate shareholder elections today.
A very crucial detail.
Now, Daniel is scheduled to publish his updated research report on Horizon Company next week. Does he have a conflict of interest that he needs to publicly disclose on the front page of his report?
According to the established frameworks, the answer is a resounding absolute yes. He must disclose the trust.
Okay, I have to play defense for Daniel here, because this feels completely irrational. We are punishing Daniel for an inheritance he can't even use. Look at the mechanical reality of his situation. He cannot touch the money. He cannot sell the stock to profit if his research report artificially pumps up the price.
That's all true.
His aunt is healthy. She could live for another 30 years. How on earth does an incredibly restricted, decades-away trust incentivize him to write a biased research report today? The conflict seems entirely theoretical.
Your pushback is completely logical if you only look at immediate short-term cash flow. But the ethical framework looks at the long-term, subtle psychological implications of what we call beneficial ownership.
Define beneficial ownership in this context.
Even though the shares are locked behind a legal wall, Daniel has a long-term pecuniary interest in the fundamental survival and growth of Horizon Company. Think about his subconscious bias.
Okay.
If Horizon goes bankrupt tomorrow, Daniel's future inheritance goes to zero. Even if he can't touch the money for 30 years, human psychology dictates that he wants the company to succeed.
Well, yeah, obviously he wants the inheritance to be there.
That desire creates a subconscious bias to view the company's management favorably, to overlook minor accounting red flags, to issue a hold rating when he should issue a sell rating.
It's the bias of hope.
Exactly. Furthermore, look at the mechanical power he possesses. Right now, he has the power to vote the shares. Voting rights are the ultimate expression of beneficial ownership. He literally has an active voice in shaping the corporate governance of the company he is supposedly objectively analyzing.
Oh man, when you put it like that.
If you are an independent investor reading Daniel's report and you are betting your own retirement money on his objectivity, wouldn't you want to know that the author is a voting shareholder whose future personal wealth is permanently tethered to the stock's performance?
Wow. When you frame it around the reader's right to know about the author's subconscious incentives.
Yes.
Yes. I would absolutely want to know. It's not about accusing Daniel of actively plotting a malicious scheme to manipulate the market. It's about acknowledging human nature. It's about giving the reader the total context of his psychological and financial ties to the subject.
Precisely. If we step back and look at the macro impact of everything we've discussed today, hidden trusts, undisclosed referral fees, churning, cherry-picked performance charts, these are the exact reasons retail investors lose faith in the financial system.
It's why people think the system is rigged.
Yes. When normal people feel like the deck is stacked, when they feel like the experts are playing a different game with hidden agendas, they pull their capital out of the market.
Yeah.
And a market without capital dies.
Trust is the actual currency.
Yes. These incredibly strict, sometimes painfully frustrating rules like forcing a brilliant analyst to pretend they forgot their own model and rebuild it from scratch, or forcing an executive to disclose a parking spot at a charity, or making an analyst disclose an inheritance they won't see for 30 years they don't exist to make life difficult.
Then what's the point of all the pain?
They exist to build a massive, impenetrable, globally recognized wall of trust around the profession.
That is a phenomenal, clarifying way to frame it. It brings us completely full circle. So let's summarize the immense journey we've taken today. We started at the absolute bedrock of professionalism, the moral courage required to actively dissociate from systemic corruption, even when it's disguised as culturally acceptable deal fees.
Right.
We explored the intellectual thrill of the mosaic theory, defining exactly how brilliant analysts legally piece together public and non-material, non-public information to find hidden value without crossing the line into insider trading.
We then explored the sacred, inviolable duty owed to the ultimate beneficiaries of our advice. We looked at the mechanics of protecting vulnerable investors from highly unsuitable complex derivatives.
Like poor Madame Tan.
Exactly. We examined the mathematical fairness required in block trade allocations, the deception of survivorship bias in performance reporting, and the massive new compliance risks of walled gardens social media platforms.
We navigated the strict loyalty owed to employers, understanding why your professional brainpower is a corporate asset and why supervisors are on the hook if they see the smoke of churning but refuse to extinguish the fire.
And finally, we waded through the nuanced, deeply psychological world of conflicts of interest, learning why even a locked-away, decades-distant inheritance fundamentally alters your objectivity.
It is a comprehensive, rigorous framework designed to protect the integrity of the capital markets from the flaws of human nature.
It really is.
Now, as we wrap up, I want to leave you, the listener, with a final provocative thought to mull over, something that builds on everything we've discussed today, but looks directly into the headlights of the future.
Okay, let's hear it.
Every single standard we have analyzed, from Victoria Adebayo's moral courage to the master chef recreating their recipe to Daniel Lyon's subconscious bias, is deeply, inherently human. The Global Code of Ethics was designed to regulate human judgment, human memory, human greed, and human loyalty.
That is the foundation of the entire curriculum.
But the financial world is digitizing at a terrifying speed. As artificial intelligence and algorithmic trading bots begin to execute millions of complex trades per second. As massive language models begin to autonomously write research reports by instantly scraping both public data and potentially non-public internet exhaust, how will a code of ethics designed for humans adapt to code?
It is the existential question facing the regulatory bodies right now.
Right. Can an algorithm actually have a conflict of interest? Can a piece of software owe a sacred duty of loyalty to a client? When a machine learning model pieces together an impossibly complex mosaic of data that no human could ever comprehend, who is held responsible if the machine accidentally factors in material non-public information it's scraped from a breached database?
It's a huge problem.
Does the programmer go to jail, or does the AI get its charter revoked? It's a massive, wild frontier that the industry is going to have to face very, very soon.
The rules will have to fundamentally evolve, just as they did for the advent of the internet and social media. The baseline of trust will remain, but the mechanics of enforcement are about to change forever.
Exactly. So, as you navigate your own professional life, keep questioning the world around you. Keep looking for those hidden biases. Ask the hard questions about the mechanics of the products you are buying, and always seek out the clearest possible view of the facts. Thank you so much for joining us on this deep dive. And remember, when you're looking at the massive global financial markets, it is never just clean binary math. You always have to be prepared to navigate the ethical, muddy waters.